there is a very big value. Repetition has a very big value. Okay, so sit back, relax, and let's go over this first section, which is largely going to be a review for you. Okay, you all have heard me say many, many times that the market is made up of a barrage of ticks or transactions. It's an almost endless sea of transactions. Every transaction, commonly referred to as a tick, right? A tick, T-I-C-K. Every transaction is nothing more than a buy and a sell. Okay? Every transaction is made up of a buy and a sell. Whenever a buyer and seller come together to meet, a transaction occurs. That's called a tick. The market is made up of an endless sea of these ticks. This sea of ticks really has no divisions. Very much like an ocean does not have a division. An ocean does not have a left side and a middle and a right side. It really does not. There are no lines of demarcation that separate parts of the ocean. If you were to take an aerial view of an ocean, you will see no divisions, no lines. The same thing applies to the market. There are no real divisions in the market. There's no beginnings, there's no end, there's no middle. It's just a ceaseless barrage of ticks. Now, out of the ceaseless sea of ticks, right, we pull out 4 ticks to pay the most importance to. Those 4 ticks are the open, the high, the low, and the close of any man-made division, any man-made period. I want you to understand that there are really no true periods in the market. There's no 1-minute period in the market. There's no 5-minute period in the market. There's no 15-minute period. There's not even a daily period or a weekly period. These divisions, these lines that separate one period from another, they're man-made. They're something that you create on your computer screen. You can simply go to your chart and all of a sudden enter the number 5 minutes. And then all of a sudden, your computer divides the market into 5-minute pieces. But those 5-minute pieces really do not exist. There are no lines. There are no divisions. There's no past 5-minute period. This 5-minute period stopped. Now we've begun a new 5-minute period. That line that separates the last 5 minutes from the current 5-minute, that line is your creation. All right? So, out of this endless barrage of ticks, once we create a time frame, once we decide to slice the market up in little bitty periods of time, all right, we then all of a sudden have an opening tick, a closing tick, a high tick, and a low tick of the artificial period we just created. Okay? Now, of the 4 ticks, guys, please try not to hit your microphone request. I don't want to hit no for the rest of the 2-day period here. Okay? Of the 4 ticks, please try to do this. Try not to hit your mic button, please. Please try not to do that. All right, of the 4 ticks, we pay the most importance to the close. I'm going to change that. That is an erroneous notion. Most people out there are trying to judge bullishness and bearishness in the market by judging the close of one period compared to the close of another. So that if RIM's close today is higher than RIM's close yesterday, they assume that's bullish. If RIM's close today is lower than RIM's close yesterday, they assume that's bearish. That is an ABC kindergarten approach to the market, and it does not work. Just because a stock closes higher than it closed the previous period does not make it bullish automatically. And just because a stock closes lower than the previous period does not mean that it's bearish automatically. You cannot judge bullishness and bearishness in the market by a simple rudimentary kindergarten-like comparison between one close and another close. The way I'm going to teach you to judge bullishness or bearishness is within the current bar. When you're looking at the current time frame that you have created, whether that time frame is a 1-minute period, whether that time frame is a 2-minute period, a 5-minute, a 15, a 30-minute, a 60, a daily, a weekly, a yearly, a monthly, it does not matter the time frame. Whatever time frame you've decided to view or look at, you look at the current bar that is not finished trading yet. The current bar that is currently trading. And you look at where the stock is currently trading in relationship to its opening period of that specific bar. So if the stock, this particular period, opened at 40 and it is trading at 41 currently, $1 above the first transaction of that period, your assumption must be that the bulls are in control of your stock right now. They may not stay in control, but right now the bulls are in control. Why are they in control? Because the stock is currently trading higher than its most recent opening tick. Every period will have a brand new open. Every bar will have a new decision as to who is controlling the stock. So, if the stock on the current bar is trading above the open, bulls are in control. If the stock is currently trading below its opening price, the bears are in control. You can do this on any time frame. Let's take a daily time frame. Let's say the market has been trading for 4 hours so far. WXYZ opened at $20. The market's day is not done yet, but 4 hours into the trading day, WXYZ, which opened at 20, is now trading at $21. It has $1 of green. Why is there $1 of green? Because the stock opened at 20. It is currently trading at 21 above its open. Anything that moves above the open paints the color green. Anything that moves below the opening tick paints the color red. All right, stock above the open, green, bulls in control. Stock below the open, red, bears in control. The opening tick is the most important tick of all because it establishes the point. It establishes the starting point. It establishes the place or the price at which the colors can begin to change. The balance of power can begin to shift. Okay? Do you understand this? Excellent. So it should go without being saying that if the stock is bullish, if the stock is trading above the opening price, and that means that it's bullish, the further the stock is above the 20, the more bullish the stock is. The further the stock is below the open, the more dominant the bears are. The larger the amount of color, the more power that side. The larger the green, the more bullish. The larger the red, the more bearish. Okay. Now, let's talk about what I call the 55% entry stop rule. On the left side, you are looking at a bar that is definitely trading above its opening price. Right? Now, the green is always measured between the open and the current price, or the last price. Okay? So the space between the open and the current or last price is the color. Okay? The tails represent the absolute low, so there was a movement below the open here. And then there was a movement higher than the current price. But the green part, the color will always be represented between the open and the current or last price. Again, if the stock is currently trading above the open, the bar will be green. If the stock is currently trading below the open, the bar will be red. So on the left, it means that the bottom of the green box is the open, the top of the green box is the last price. In the right-hand scenario, the top of the red box is the open. It dropped, producing red, and the bottom of the red box is the last price or close. Now, the bulls are in control of the bar to the left. Why? Because the stock is currently trading above the opening price, and the vast majority of the bar's range is green. Now, if the bulls maintain more than half of the green that they at one point produced, they remain in control. If the bulls lose 55% or more of the green that they once produced, they actually lose control. So let's put prices to this. Let's say this stock that you're looking at now opened at $20. Okay? The stock has risen to $21. It is currently trading at 21 after opening at 20. Okay? Now, the halfway mark is going to be $20.50. If the green was to start to fall back, okay, and fall back below, significantly below $20.50, right, because the halfway mark is $20.50. If the stock were to fall back decently below $20.50, your assumption would have to be that the bulls will have lost control. Why? They had more than $1 of green at one point. At the high, there was more than $1 of green. And then they started to lose their greenness. The bulls got pushed back and lost more than half of the green that they once had. Bulls are now not in control. Even though the bar is green, the amount of green in relation to the bar's range, look at what I'm drawing here. This is important. This is the bar's range. Only this percentage of the bar is now bullish. You see this? Only this percentage is bullish. This percentage, which is 55%, more than half, is now bearish. So more of the bar is bearish than bullish, which is actually even smaller. Does this make sense? Okay. That's why the bulls lose control, because the bears have moved the stock more than the bulls were in the final analysis. Okay, good. I'm glad we're on the same page. So the 55% level, you don't go out there and start trading with a ruler. Okay, that's not what I want you to do. Don't go there and trade with a ruler. You just eyeball it. It's not something that has to be extraordinarily precise. It's about, you find about halfway and a little bit beyond the halfway mark of your color. Now, here's something I think it's important to point out. When you're looking at a green bar, the green bar opens at 20, right? Then starts rallying and rallying. Rallying. It's moving up, right? Above its open. At one point, this was where the stock was trading. All right? So at the high, this bar from open to the last price was all green. Then it backed off the high a little bit. Okay? That tail indicates where the tippy top part of the green used to be. So our 55% mark must be measured from this tip downward. What's 55%? Assuming your green was there, and it was, 55% down from the tip. Okay? Not 55% from here, 55% from the tip, because that was there. It's already started going down. Does this make sense to you? Okay. If you're looking at a red bar, understand that at this little wick represents where the red was at one point in the bar's range. So when we go back, if the bulls lose 55% or more of the red that they once produced, they lose control of the market. Even though this bar is still red at this point, more of the bar's range is bullish than bearish at this point. This part is bull now, and only this part is bearish now. It's a much smaller part of the bar's range is bearish now. The bulls have moved the market more than the bears. So how do we measure the 55% level? Well, you have to assume, you have to do it from the tip at the low up. You see, this has already, this has already started to rise a little bit. So 55% must always be measured from the tip at the low on red bars and from the tip at the high on green bars. There's my 55% from the tip, not from the red, not from the actual red, because the red has already started to rise. This was red at one point. Now there's less red. Now there's less red. 55% from the low all the way back up has now been achieved. Okay, I think we've got that. No, that is wrong, Steve. Partially right, but not totally wrong. Steve is saying, in other words, ignore the color and concern yourself only with the high and low. No, not the high and low. It is the open and the high or low, depending on the color of the bar. Let me explain that. The open in this bar is here. The open starts your color. Not the low doesn't start your color, if there is a low. The open starts your color. So now from the open to the top is your range. And this is 55% of your range. The open of a red bar is at the top of the color. So now you measure your 55% from the open to the low, not from the high to the, not from the high to low, from the open starts your color. Does this make sense, guys? From the open to the low on a red, from the open to the high on a green. Okay. The open is the most important tick because it tells you where the color is going to begin. Okay? The first trade of a day tells you where the color is going to start. If the first trade is $20, if it moves to $20.01, it's got 1 cent of green. If it moves to $19.99, it's got 1 penny of red. The opening tick establishes where the starting point is for your color. And so you start to measure open. If it's green, open to the high. If it's red, open to the low. Okay. Now, let's assume, I want you to assume that if the bar closes green, okay, if the bar closes green, okay, as long as the bulls maintain most of the green, they are in control. And on the right-hand side, as long as the bears maintain most of the red, they are in control. Okay? Now, if the next bar opens, all right, the next bar opens, the opening tick is neutral because the opening tick is not a color yet. The opening tick establishes where the color is going to potentially begin, but the opening tick has no color. If we move above the opening tick, the color starts to be green. If we move below the opening tick, the color starts to be red. Now, momentum style traders trade in the direction of the last color produced. So if this color, the last color produced was green, they would look to buy, momentum traders would look to buy the next bar, but not at the open like this. They wouldn't buy here yet. They'd let the stock open, and then if the next bar starts to produce a little bit of green, they jump on board, assuming that the green is going to continue. These are momentum style traders. They buy in the direction of the most recent color produced. The most recent color produced was green. They're going to buy into the next bar once they see a little bit of green. We don't see green yet. This bar is red. So a momentum style trader would say the most recent color produced is red. I'm going to short the next bar if the next bar shows me a little bit of red. At the open, you don't see color yet. Bam. This is where the momentum style trader would jump on board. Again, let me repeat that to you. This is not you necessarily, but I'm explaining a very popular style of momentum play. The momentum trader looks to buy in the direction of the most recently completed color. Now, the most recently completed color must be decent size. It must be a decent green bar. It's not a feeble green bar. It's not a tiny green bar. It's not a suspect green bar. It's a nice, tall, solid green bar. Once they get a nice, tall, solid green bar, momentum traders buy the next bar. Once the next bar starts to show them a tiny bit of green, boom, they enter. Now, the momentum style traders that I train, if they play this style, they're going to buy into the bar at this particular point with a stop 55% into the previous bar's green bar's range. So as long as the stock stays above the previous bar's 55% retracement level, nothing is wrong. So they would buy into the next bar with a stop at the 55% retracement level of the previous green bar's range. This is ample or acceptable squatting room for the stock. In order for a basketball player to leap, he must first squat, and you must also give your stock squatting room. You keep lines every day, a day apart, or a line a week apart, or a line 1 minute apart, does not change the market behind the window you're drawing your lines on. So what I'm telling you is that the market is going to do whatever it always does, no matter where you draw your SOAP line. Does this concept make sense to you? So what it means is that the things I'm teaching you happen in every time frame. Your SOAP line does not manipulate the activity I'm going to teach you. Your SOAP line does not change the backyard. Your SOAP line, no matter where you draw it, I'm going to draw 5-minute SOAP lines. I don't care where you draw the line, what time frame you decide to look at the market. What I'm going to teach you happens behind the SOAP lines. So you can decide to look at the market in 1-minute slices or 2-minute slices or 60-minute slices. It will not matter. Everything I teach you is applicable in every time frame. People have this notion that if I change my SOAP line, I'm going to change the market. Maybe that doesn't happen in this time frame. You don't change the backyard. You don't change the background by changing your screen. I wish I could change the market from my screen. That doesn't happen. All right. All right, cool. Well, I'm glad those little corny things help. All right, that comes from having little kids and you have to break things down. All right, guys, this is full control. All right, full control. What I call full control is a bar that is mostly color. Now look at this. This is not a bar that's mostly color. That's a bar that's not mostly tail. But full control by the bulls means that most of the bar's range from high to low is color. So here's the bar's range. From high to low. And most of the bar's range most of that range is color. So if most of the bar's range is color, it's full control. Doesn't have to be all of it. Absolute control would be this. Okay, this is full control. These are full control bars. Most of the bar's range is green to the left. Most of the bar's range is red to the right. Now, as long as the bulls maintain most of their green, they are in control. As long as the bears maintain most of their red, they are in control. Now, this is called good control. All right? This is absolute control. It's at the high. We come off the high a little bit. That's full control. We come off the high more. Now I'd say that's good control.